Here's what I'm watching closely right now, and it's something that should concern anyone paying attention to consumer spending trends. CarMax just reported their Q3 earnings, and buried in those numbers is a warning signal that could be telling us something critical about where the economy is headed. Comparable store sales dropped 9% year over year. That's not a minor softness, that's a significant contraction in one of the largest used car retailers in the country. And when I dig into what's driving this decline, the implications extend far beyond just the auto sector. Let me walk you through what this data is actually telling us about consumer health, credit conditions, and what this could mean for employment and markets in the months ahead. Now, understanding CarMax's position in the economy. First, let's establish why CarMax matters as an economic indicator. They're the largest used car retailer in the United States, with over 240 locations nationwide. They see real-time consumer behavior, people walking through their doors, financing decisions being made, trade-in values, credit approvals, and actual transaction volumes. Used car sales sit at an interesting intersection in the economy. They're a major purchase for most households, typically financed, and they're often a necessity rather than a discretionary luxury. When people stop buying used cars, it's usually because their financial situation has deteriorated to the point where they can't qualify for financing, can't afford the monthly payment, or they're uncertain enough about their employment that they're delaying the purchase. This makes CarMax's sales trend a real-time window into consumer financial stress. A 9% comparable sales decline is substantial. This isn't a comparison against some extraordinary pandemic-era spike. This is comparing Q3 2024 against Q3 2023, both relatively normal operating periods. What makes this particularly noteworthy is that we're still in an environment where the used car fleet is aging. The average age of vehicles on the road has been increasing, which theoretically should drive replacement demand. Additionally, we've seen new car prices remain elevated, which typically pushes more buyers into the used market. So CarMax is facing a 9% sales decline despite structural tailwinds that should be supporting used car demand. That tells me the headwinds, consumer financial stress, are overpowering the fundamental demand drivers. Let me walk through the mechanics of what's happening to household finances, because this explains why we're seeing this weakness at CarMax. Over the past 3 years, consumers have faced persistent inflation in essentials. Food, energy, insurance, housing costs, these have all increased significantly. Even though wage growth has been positive, it hasn't kept pace with the cumulative inflation impact on household budgets. The result is that discretionary income, the money left over after covering necessities, has been shrinking for many households. Early on, consumers bridged this gap by drawing down savings and increasing credit card balances, but both of those buffers are now largely exhausted. Personal savings rates have fallen to levels we typically see late in economic cycles. Credit card balances are at record highs, and more importantly, delinquency rates are rising. This means consumers are tapped out. They don't have the financial capacity to take on another monthly payment for a vehicle. Here's where it gets more specific to the auto market. The average monthly payment on a used car purchase has increased dramatically. This is partly due to higher vehicle prices, but also due to higher interest rates on auto loans. When the Federal Reserve raised rates aggressively, that flowed through to auto loan rates. A consumer who might have qualified for a 4% auto loan 2 years ago is now looking at 8 to 10% or higher, depending on their credit profile. That interest rate difference translates directly into higher monthly payments. For a $30,000 used car financed over 60 months, the difference between 4% and 9% interest is about $130 per month. For a household already stretched thin, that additional $130 might be the difference between qualifying for the loan or not, or between feeling comfortable with the payment or walking away from the purchase. This dynamic helps explain why we're seeing the sales weakness despite ongoing need for vehicle replacement. Another data point buried in CarMax's report relates to trade-in values and wholesale operations. When consumers are financially stressed, trade-in behavior changes. People hold on to vehicles longer, delay trading up, and when they do trade, they're often trading down rather than up. CarMax's wholesale auction business provides insight into this trend. If wholesale volumes are soft and prices are under pressure, it suggests that trade-in activity is declining. Consumers aren't cycling through vehicles the way they normally would during a healthy economic expansion. This meshes with what we're seeing in the broader data on average vehicle age and vehicle miles traveled. People are stretching their current vehicles as far as they can rather than taking on new debt for a replacement. Here's where this connects to broader economic concerns. Auto purchases are highly sensitive to employment conditions and employment expectations. People generally don't finance a major purchase unless they're confident in their job security and income stability. When I look at the leading indicators in the labor market, I see reasons for consumers to be cautious. Initial jobless claims have been trending higher. Continuing claims, people staying on unemployment for extended periods, have been elevated. Job openings have declined significantly from their peaks. Perhaps most telling, surveys of consumer income expectations show deterioration. When people expect their income growth to slow or their job security to weaken, they pull back on major finance purchases. That's rational behavior, and it's exactly what we're seeing play out in CarMax's sales data. Another factor pressuring auto sales is tightening credit conditions. Banks and auto finance companies have been pulling back on lending, particularly to subprime borrowers. The charge-off rates on auto loans have been increasing, which makes lenders more cautious about who they approve. This creates a feedback loop. As lenders tighten standards, fewer consumers qualify for financing. That reduces sales volume, which pressures vehicle values. Lower values mean higher loan-to-value ratios on new loans, which makes lenders even more cautious. The cycle reinforces itself. We saw this dynamic play out in 2008, though the current situation is nowhere near that severity. But the pattern is recognizable. Tightening credit, falling sales volumes, rising delinquencies, further credit tightening. Regional variation matters. One aspect worth noting is that CarMax operates nationally, so their results capture regional economic variation. Some regions are experiencing more acute economic stress than others. Areas heavily dependent on specific industries, or areas where housing affordability has deteriorated sharply, tend to show weaker auto sales. The fact that CarMax is seeing a 9% decline across their entire footprint suggests this isn't just a regional phenomenon, it's broad-based consumer weakness. From a market mechanics perspective, the used car market has been through unusual volatility in recent years. During the pandemic supply chain disruptions, used car prices spiked dramatically. That spike has since reversed, with prices coming down significantly from those peaks. For consumers, this should theoretically be positive. Lower prices mean more affordability, but the issue is that many consumers who bought during the price spike are now underwater on their loans. They owe more than their vehicle is worth, which makes trading in difficult or impossible. This negative equity situation traps consumers in their current vehicles and suppresses trade-in activity, which in turn reduces inventory supply for dealers like CarMax. It's another feedback loop working against sales volume. Let's zoom out and consider what CarMax's results tell us about the economic trajectory. Auto sales, new and used combined, are a significant component of consumer spending. They also drive activity in adjacent sectors: finance, insurance, maintenance and repair, parts, fuel, etc. When auto sales weaken materially, it tends to presage broader consumer spending weakness. The reason is that the factors driving people to delay auto purchases, financial stress, employment uncertainty, tapped out credit, also drive them to pull back on other discretionary spending. We're already seeing this pattern in other consumer categories. Retail sales data has been showing weakness outside of essentials. Restaurant traffic is declining. Travel and entertainment spending is softening. The CarMax data fits into this broader pattern of consumer retrenchment. Here's where this gets concerning from an economic cycle perspective. When consumer spending weakens, businesses respond by cutting costs. The most significant cost for most businesses is labor, so weakening consumer spending tends to lead to layoffs and hiring freezes. Those layoffs then reduce household income, which further pressures consumer spending. It's the classic recession feedback loop. Spending weakness leads to job losses, which lead to more spending weakness. We're not in that full cycle yet, but we're seeing early indicators. Some retailers have announced layoffs, some restaurants have closed locations, tech companies have continued cutting staff. The CarMax data suggests we may be closer to that inflection point than many realize. From a market perspective, this matters because earnings expectations embed assumptions about consumer spending. If spending is weakening more than expected, which the CarMax data suggests, then earnings across consumer-facing sectors are at risk of disappointment. The stock market has priced in a soft landing scenario. Growth slows modestly, inflation cools, the Fed cuts rates, and corporate earnings remain resilient. But if we're actually seeing the early stages of a spending-driven slowdown, that soft landing narrative gets challenged. Auto sector stocks could face pressure. Retailers could see multiple compression. Consumer discretionary stocks broadly may underperform. And if the weakness spreads to employment, even the mega cap tech stocks that have driven market gains could face headwinds as enterprise spending tightens. Here's an interesting dynamic to consider. The Federal Reserve has started cutting rates, which theoretically should help auto financing affordability. Lower rates mean lower monthly payments, which should support demand. But there's a lag between Fed rate cuts and the actual rates consumers see on auto loans. And more importantly, if the Fed is cutting because the economy is weakening, that creates uncertainty that can offset the positive impact of lower rates. Consumers worried about losing their jobs don't take on car payments just because the rate is a bit lower. This is the paradox late in cycles. The very conditions that prompt rate cuts also create consumer caution that limits the effectiveness of those cuts in stimulating demand. Historical patterns. Worth noting. When I look at previous economic cycles, weakness in auto sales has often been a leading indicator of broader downturns. In 2007, auto sales started softening well before the general recognition of recession. In 2000, similar patterns emerged. The reason is that auto purchases are both durable and financeable. Consumers can delay them when uncertain, and credit availability impacts them directly. This makes the sector sensitive to early-stage economic stress. CarMax's 9% comparable sales decline is the kind of data point that historically has preceded broader economic weakness. It doesn't guarantee a recession, but it certainly raises the probability. Beyond the national data, it's worth considering regional variations in economic stress. Areas with high concentrations of job losses, regions with severe housing affordability issues, or locations heavily dependent on industries facing secular decline, these areas tend to show auto sales weakness first. CarMax's geographic footprint gives us visibility into these regional patterns. If the weakness is concentrated in specific regions, it might suggest localized stress rather than national recession, but if it's broad-based across all regions, that's a more concerning signal. This data also raises questions about policy response. If consumer spending is weakening to the point where auto sales are declining 9%, does the Federal Reserve need to cut rates more aggressively? Do we need fiscal stimulus? The challenge is that traditional policy tools may be less effective in this environment. Interest rates are still historically low, even after the recent hiking cycle. Fiscal policy is constrained by large deficits and political gridlock. And monetary policy works with long and variable lags. By the time the Fed's recent cuts impact the economy, we may already be in a more serious downturn. Several indicators can help us determine whether CarMax's weakness is an isolated issue or a broader trend. Watch other auto retailers and manufacturers for similar guidance. Monitor consumer credit data for rising delinquencies. Track retail sales data for confirmation of spending weakness. Employment data becomes critical. Watch initial claims, continuing claims, and monthly payroll reports. If layoffs accelerate, the feedback loop I described earlier gets set in motion. Also, watch consumer sentiment surveys. If confidence deteriorates further, it confirms that households are becoming more cautious and likely to delay major purchases. From an investment perspective, this data suggests increased caution on consumer discretionary exposure. Companies dependent on consumer financing and big-ticket purchases may face headwinds. Defensive sectors, utilities, healthcare, consumer staples may outperform if economic concerns increase. Credit markets warrant attention as well. If consumer credit stress is building, corporate credit spreads may widen, particularly for issuers in consumer-facing sectors. This could present opportunities in high-quality bonds as spreads widen. The dollar and treasury bonds could benefit from flight to quality flows if economic data continues deteriorating. These are traditional safe haven assets that tend to perform when recession risks rise. One aspect that deserves consideration is the potential for deflationary pressures. If consumers pull back significantly on spending, it creates disinflationary or even deflationary pressure across the economy. We're already seeing this in used car prices, which have fallen substantially from their peaks. If that pattern spreads to other categories, it changes the inflation outlook and the Fed's policy calculus. Deflation can be more damaging than inflation because it increases real debt burdens and can create a downward spiral in spending and investment. What I take away from CarMax's 9% comparable sales decline is that consumer financial stress is more acute than headline economic data suggests. GDP growth might look reasonable, unemployment might still be relatively low, but underneath those aggregates, many households are struggling. Those struggling households are pulling back on finance purchases. They're delaying vehicle replacements, skipping discretionary spending, and preparing for potential income disruptions. That behavior, if it continues and spreads, has significant implications for economic growth, corporate earnings, and market performance. This is the kind of data point that warrants close attention. It's not necessarily predictive of immediate market crashes or economic collapse, but it's a warning signal that the consumer, the engine of the U.S. economy, is running out of gas. For anyone trying to navigate markets and the economy, understanding these early warning signals provides an opportunity to adjust positioning before larger moves occur. That's the value of paying attention to companies like CarMax that give us real-time insight into consumer behavior. This analysis is provided for educational and informational purposes only. It represents my interpretation of publicly available data and should not be considered financial advice. Economic conditions can evolve rapidly, and individual circumstances vary significantly. Anyone making financial decisions should conduct thorough research and consult with qualified professionals appropriate to their situation.